Peer-reviewed research has shown that certain types of stock outperform the general market over the very long term. These are called factors. Hundreds of factors have been discovered, but Vanguard have taken 4 of them and industrialized their use so that for just 22 basis points you can get exposure to 4 factors. So let's see how these factors work and what you can expect from them over the very long term. Remember, this is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Vanguard factor funds are all about beating the market. So what do we mean by the market? Instead of buying a single stock or a single bond, you can buy a whole stock market for one country or the entire world. For example, you can buy a fund that tracks the FTSE All-World Index. You'd quite literally be buying all the stocks in the world, or at least 90 to 95% of them. And here's one of the funds offered by Vanguard, which does exactly that. The VWRL fund tracks over 3,000 stocks around the world, and it does so very cheaply. You just pay a fee of 0.25% of your invested amount every year. But what if instead of trying to track the global markets, you wanted to beat them? In that case, you've got 3 options, and here I've ranked them according to the likelihood of success. The least likely option is do-it-yourself stock selection. Sure, you can look at individual stocks, you can try and choose ones which are better than the overall market, but good luck with that. Even professionals struggle to beat the market over the long term. Your second option is to pay a fund manager. These are experts who have a huge amount of resources, information, and training whose job is purely to beat the market in return for a fee from you, the investor. But if you look at the evidence from surveys such as the SPIVA survey produced by S&P, the success rate of those fund managers is extremely poor. The third choice, which is the focus of this video, are factor funds. So let's take a look at an example. The FTSE All-Share Index represents almost all of the stocks you can buy on the London Stock Exchange, and the FTSE 250 are the mid-cap stocks. And you can see that over this time period since the end of 2015, the returns have been about 17 or 18% for the market overall. So that's the market we're trying to beat. A very successful active fund manager in the UK is Terry Smith, and his Fundsmith fund has returned 63% over this period. In order to do this, he's taken a very high concentration in just 2 or 3 sectors and in about 20 to 30 stocks. And there's a whole cult of personality that's built up around Fundsmith and Terry Smith's ability to pick stocks that outperform the overall market. But if you look at the Vanguard Value Fund, that's running almost neck and neck with Fundsmith, and the fee for the Vanguard Fund is 1/5 that of Fundsmith. So where do these factors come from? Well, they're based on peer-reviewed research. And possibly the most famous paper of all is this one by Farmer and French. It was published in 1992, and they showed that certain types of stock would consistently beat the markets if you look over very long periods of time. In this paper, they looked at the size of the stock, or the size of the company. And what they found was that small companies tended to outperform large companies, and that cheap companies, measured by something called price-to-book ratio, would also outperform over the long term. Later research by people such as Mark Carhart added other factors into the mix. In this paper, Carhart talks about the momentum effect, which is the tendency of stocks which have outperformed in the past to continue outperforming. And since those seminal papers were published, the number of factors published each year has proliferated. Now we're getting about 20 new factors added to the fold every year. Now the size of this outperformance is not colossal. For example, value stocks, momentum stocks, low liquidity stocks have only outperformed by between 2.5% to 3% over the long term. As with any fund, you should always consider the cost you're paying for the fund. One of the ETF analysts for Bloomberg Intelligence, Eric Balkunas, describes this as the Vanguard effect. Since the 1970s, Vanguard's fees have been plummeting, and since 2000, active fund managers have had to cut their fees in response. Vanguard has an almost religious dedication to keeping fees low, and that's true of their passive funds, which simply track an index, as well as their active funds, such as these factor funds. So it's no surprise that the fee is actually very low, only 22 basis points for all 4 funds. Now that we have MiFID II, we can also look at the transaction costs in addition to those ongoing costs, which you can see here in blue. The transaction costs are in red, and you can see that for some of the funds, such as the global momentum factor, which tends to move around a great deal, and which requires a greater turnover of stock, that adds quite a bit to the total cost of ownership. On top of that, you have to pay some kind of account fee, and if you have a Vanguard Direct account, that's another 0.15%. But even factoring all of those costs in, these are the kind of fees you'd expect for a passive tracker, and yet here you're getting a very active fund which packages a very sophisticated product. So let's look at the first fund. This is value. The most famous investor in the world is Warren Buffett, and he's a proponent of value investing. He has various models of what a stock is worth, and when he sees a stock that's trading at less than his theoretical price, he'll buy that stock. So it's almost as if Vanguard has taken Warren Buffett and boxed his approach into one fund. Instead of looking at just one theoretical model of stock price, Vanguard used 3. One of them is book to price, which we saw in that Farmer and French paper from 1992. The second is forward earnings to price, where they try to forecast the earnings of a stock in future and then measure the price relative to those earnings. And the third measure is price to cash flow. They combine those scores, they take the top third most highly scoring stocks, and those are the ones put into the value factor ETF. The fund contains over 1,000 stocks, and you can see that it's diversified across country and across region, although as with any index, it has a very high weighting to the US because the size of the stock market there is simply huge. It makes up about 40% of the global stock market. The Momentum Fund tries to capture stocks which have outperformed in the past because these tend to rally in the future. The reason why this factor works is that people tend to crowd into trades which are successful. They also tend to overreact to good news. When a stock has good earnings, that tends to feed into its stock price for far longer than it should, even once it's gone above its fundamental value. So Vanguard look at the stocks which have outperformed over an 11-month, 6-month, and a 1-year period, risk adjusted. Again, they combine those scores and they look at the top third stocks and buy those as part of the Momentum Factor ETF. This fund contains over 1,000 stocks, and again, it's diversified across region and across country. The liquidity factor tries to capture stocks which are traded less frequently. These are harder to sell, and so you get a premium for taking the risk of not being able to sell so quickly. You can think of liquidity as how long it takes to sell a stock. So for example, emerging market stocks tend to be less liquid. They trade less frequently and in smaller dollar amounts than large developed market stocks. Vanguard measure liquidity in 3 different ways. Firstly, what percentage of the stock turns over on a daily basis? Secondly, what's the dollar amount? In other words, the monetary amount of stock that turns over on a daily basis. And the third measure is called the Amihud illiquidity measure, which looks at the impact on the stock price of large trades. Illiquid stocks tend to be affected more when there's a large trade than liquid stocks. Again, we combine these 3 factors, take the top third highest scores, and buy those stocks as part of the Global Liquidity Factor ETF. And yes, you guessed it, there are over 1,000 stocks, and it's diversified across region and country. Now, minimum volatility is a slightly different beast, because here you have to think about the portfolio as a whole. Vanguard uses an optimizer to work out which stocks go into this fund, and it's much smaller than the others, as we'll see. They try to balance risk factors such as country, sector, or too much concentration in individual stocks, and they also hedge it in US dollars, and that reduces the volatility of the fund. Now, if it was just a low volatility fund, they choose stocks which individually have low risk. But because they're thinking of the fund as a whole, they can look at stocks which may not have such a low volatility, but which have negative correlation with each other. In other words, they can diversify the fund. And that increases the opportunity set of securities which they can buy. So this fund only has just under 200 stocks at the moment, but as with the other funds, it's diversified across region and country. So let's take a look at the risk and return of these funds. You can see that since they've been around, which is not very long, we only have 2 years of data, the performance has been quite good, with value performing best of all. If we look at the risk-return plot, where risk is on the x-axis and return is on the y-axis, value is in the top right. That's the ticker VVAL. It has the highest return of over 15%, but it also has the highest risk of over 14% volatility. In the bottom left in green, you can see the minimum volatility fund. By design, that has a low volatility, so it's well to the left of the graph, but it's paid the price by having a lower return, at just over 10%. For comparison, I've also shown the VUSA, which is the S&P 500 stock index for the US, and VWRL, which is the Global Equity Fund. And you can see that momentum and value have outperformed both of those indices. But be careful, because this is a fairly short time period. 2 years is far too early to tell whether these will succeed in the long term. Now, it probably doesn't make sense to buy more than one of these funds because they're highly correlated with one another. So for example, you can see that value and liquidity have a correlation of 0.93, which is very high. So they tend to double up on risk. If you buy one and you buy another, that won't diversify the portfolio. They also have a very high correlation to global equity markets. So this is more of a substitution fund rather than something you'd have alongside your existing global equity fund. And here's a very brief factor user's manual. Firstly, you have to be very patient when you use these funds. That's because for very long time periods in the past, they've underperformed. So if you buy one of them and it underperforms for a year or even 2 years, don't be surprised. To get the most out of these funds, you should plan to invest for more than a decade and to stick with that investment. If you look at this factor performance ranking from 2005 to 2014, you can see that the best performing factor moves around a great deal. So don't be surprised if your factor isn't top of the pops as it's been in the recent past. Vanguard has this guide as to how you should think about their factor funds, and they give 4 reasons for using them. I think the 2 key ones are enhancing return and substitution, and the minimum volatility fund might be considered for risk reduction. What they mean by substitution is, say that you have a value fund which is actively run and which is very expensive. What the value factor fund offers is a way of substituting a very cheap fund which effectively gives you the same exposure as your more expensive actively managed fund. Vanguard also have a nice paper which lists all of the potential explanations for why the factors work. But really, at the end of the day, it's based on empirical data. People have just observed what kind of stocks outperform and then come up with post hoc explanations as to why that might be the case. And also, don't be surprised if your fund doesn't track global equity markets. These are highly active funds. In other words, they diverge from global equity markets as measured by VWRL very significantly. Their active share, which is the size of that deviation, is extremely large. But of course, that's the point. If they do choose stocks which outperform the broad market, then you'd expect them to deviate from that market. I hope that explanation has been clear. Some people have said these factor funds are very difficult to understand. So if you want to get in touch, please contact me for a power hour and we can discuss these and other funds in more detail. And if you want to see more of these videos, then subscribe to our channel.